Welcome out to the BluSky Trading Lab. This is Coach Matt. We're going to have a lot of fun today as we do a little bit of back testing and really talk about a couple trades that I was looking at this week. And I think some of you were probably in those trades as well. But I want to talk about entry technique today to really kind of get an understanding of how we all kind of handle getting involved into a trade, making those decisions, really kind of what I like to look for in processing a trade. What's up, MJ? What's up, everybody? Welcome out to the lab. No doubt about that. Now, first and foremost, how's everybody doing today? Is everybody having a fantastic day? Did everybody have a good trading day? Tell me how everybody did today. I thought it was a fantastic day, RQ. We all end in green? Did we all get green today? Isn't that kind of the goal every day? Kind of finishing that green. Well, what I want to do here is I just want to do a little bit of a backtrack real quick, just to kind of talk about some technical analysis in general. And if you recall the very first lab, do you guys remember that very first lab we did? Like it was like 3 months ago, 2 months ago. I can't even remember what it was, but it was like 2.5 months ago. And I talked about trend analysis, and I talked about multiple time frame analysis and the 1, 2, 3 pattern. And so I just want to first timer, love the first timers, MJ. We do this every Thursday, same time, same channel. We work on our skill set every single week in this lab. And so first time, let's do it a long time next week as well, my friend. But if we recall, for those of you that were there that first time, we talked about multiple time frame analysis. We talked about different patterns. We talked about trending analysis. And in general, and yes, you can always find the previous editions of the lab on the BluSky YouTube as well. But in general, guys, I talked about it from a time frame perspective. What time frames do you use? What are your anchors on your time frames? And so I just want to ask you guys a question. What is your time frame? And I'm just going to pick 2 time frames here. What is your time frame that is your home base? Like that is your go-to time frame. You live on that time frame. You love that. You do all your trend analysis on that time frame. You just love that time frame. What's your one time frame that you just love? Okay, 15, RQ 15, Bucky 5 and 15. Awesome. Now, is the time frame you do all of your analysis on the same time frame you do your execution of your trading on? Okay. Now, for me, I do all of my analysis from a trending perspective on the 30 or the 60-minute time frame. So I'm a 30-minute guy. I'm a 60-minute guy. I like to look for the major zones on that time frame. I like to look for the base understanding of trend analysis on that time frame, but I don't live on that time frame, guys. I just kind of look at it. For example, you look at the S&P 500 today, and what do we have? You look at the S&P 500, and let's get it on that 1 hour or 30-minute time frame. And what do we have? We have a bullish uptrend. Okay, so the 30-minute time frame is bullish. The hourly time frame is bullish. What does that tell me? It tells me that I should be looking for bullish trades. That's what it tells me. I always trade in the direction of the trend. I'm a trend trader. I'm a pattern trader. And how many of you guys are familiar with the turtle traders? The Richard Dennis turtle traders, their kind of story. Are you familiar with them? Not turtle soup. It'd be a little different. The turtle traders, guys, were really the first group of traders that basically proved that they could learn other people's systems and trade other people's systems successfully. See, before the turtle traders existed, there was a Wall Street and a Main Street, and there still is. This is 45 years ago, guys. There was a Wall Street, there was a Main Street. Wall Street said, Main Street is not smart enough, is not good enough, cannot control their own money, cannot make their own trades. And they were really talking about just having the internal fortitude necessary to be able to handle risk is what they were talking about. And so there was a guy by the name of Richard Dennis, and I'm not going to tell the whole story. I'll just kind of give you the very, very quick Cliff Note version. But in the early 1980s, he took out an ad in the Wall Street Journal and said, I'm willing to teach anybody how to trade. You have to have zero trading experience, and you have to have fresh eyes and be willing to learn a system. Come to this class, spend a week learning the Richard Dennis trading system, and then you're going to spend a week learning, and then you're going to spend a week applying. There were 8 original turtle traders and ended up being over 12, but really kind of that original 8 to 12. Now, Richard Dennis took traders from different demographics, young, old, rich, poor, you name it, different demographics, and basically taught them how to trade the first week. He then helped them apply how to trade the second week. Now, the reason this is important is because there was a first trade in that saga. And the first trade they took called for a breakout, okay? And it called for a breakout of resistance. They were breakout traders. And basically, the market was kind of sitting right here in a little bit of a breakout pattern. And the trade called for an order to go right above resistance. And so right when the market went above resistance, you were supposed to get into the trade. And the stop loss was supposed to go right underneath the previous pivot going into the breakout. And so the trade called for an entry above resistance and a stop loss underneath the pivot point going into resistance. Pretty simple trade structure. Of the, we'll just say the original 12. Okay, so there was 8, eventually went to 12. We'll say 12. Of the 12 turtle traders, the ones that were the original ones, how many of those 12 traders took the trade? What do you guys think? Richard Dennis made the trade. Think about this like Riz is in there, Coach Matt's in there, Mike's in there, Steve's in there, and they're making a trade. Okay, how many took it of the 12? Like there's 13 here. How many of those 13? It was half, Bucky. You're right. Bucky's absolutely right. It was 6. 6 of the 12 took the trade. 6 didn't. Now, what was curious about the 6 who didn't is they were asked the question, why didn't you do it? And a lot of it was, well, I didn't want to lose money, or a lot of it was, I didn't know, and a lot of it was just hesitation. They weren't even trading their own money. They were trading Richard Dennis's money. And so 6 didn't even take the trade. 6 did. Now, the trade called for them to stay in the trade until it went to resistance. And basically what happened is initially the trade went up, and then pulled back. And on the initial pullback, it didn't hit its first target. And 3 of the traders got out when it started pulling back, which meant only 3 of the traders were in the trade at this point. Now, the trade didn't say, get out of the trade. They got out of the trade. Why did they get out of the trade? Why did those 3 get out of the trade on the first pullback? It has everything to do with money. It's their relationship to money. They started seeing the money they made. Exactly, Bucky. They started seeing the money they made start to go back. And out of fear of losing everything that they had made, they just got out of the trade, right? They cut their gains short. The exact opposite of what we need to do. They cut their gains short. Well, on that initial pullback, 3 traders stayed in. The 2 traders closed out of it right when it got back up into the next level of resistance because they had made back what they thought they lost. See, only 1 trader stayed into the trade, the entire trade, all the way back up in to the next level of resistance. Only 1. Only 1 out of the 12 stayed in the trade. Why, guys? Why? I think this is important. Why was it only 1 of the traders made the successful trade? You want to be right? The logic of that individual was fascinating to me, and I'll give it to you here in a second. But I always think about the 11 who didn't stay in the trade. Now, the turtle traders went on to become very, very famous, and all of the turtle traders became very successful traders, but not like this one individual. The 11 people who did not stay in the trade, they didn't stay in the trade, guys, because they made decisions over money. Every decision they made in the trade had nothing to do with the actual trade, and it had everything to do with the money. Either they were making money or they were losing money, or they were scared of losing money or whatever, but it had nothing to do with the trade. And that always stood out to me because I know in my life, especially when I was a young trader, that's basically what I would do. I would allow my lack of relationship with money to dominate my trading decisions. You were making money, all of a sudden it's like, oh yes, we're making money. Ooh, oh, I usually have to go work for money. I usually have to expand my time for somebody else's money. Well, now that I'm making money just by trading, oh, I got to pull it off right now. I got to pull it off right now. Well, that's not what we need to do. We need to let that puppy run. You need to let the trend play out. You need to let the trade play out. You need to let the stop loss do the work. The more decisions you make up here when the trade is live, usually you're making mistakes. Now, somebody asked the one trader who stayed in the trade. It was the youngest person in the class. It was an 18-year-old kid who had never traded before. And his entire logic on the trade was this: I was staying in that trade as long as Richard Dennis stayed in the trade. See, Richard Dennis made the trade too. Richard Dennis prepped the trade out. It was only one individual, the youngest in the class, 18 years old, was able to actually trade it to its completion, because it had nothing to do with the trade and it had everything to do with, I want to be like Richard Dennis. And so that always stood out to me, not necessarily so much of what Curtis Faith did, and that's what the young individual's name was Curtis Faith. He went on to trade millions and hundreds of millions of dollars and so on and so forth. He also had, it was also a pretty sad conclusion to his story as well. Got involved in drugs and stuff like that. But at the end of the day, the lesson that I took out of reading about the turtle traders is that I need to stop making decisions around money. And I need to simply allow the data to play out, perfect my systems, apply my systems, hell or high water, hell or it doesn't matter. Trade your system. Now, RQ Richard Dennis, that's the guy that turned four figures. Richard Dennis, I don't know what he ended at, RQ, but Richard Dennis was basically a guy who turned, I want to say 1 million into 100 million is what he did. Yeah, I think it was like it was like his own money, and then he started trading other people's money as well. But from the story I understood, it was under $1 million he had, and he basically tested out his system for about 4 years in the late 70s before he perfected his own system. And then he went live with it. And yeah, he turned like $1 million into $100 million. Now, he also got involved in like 77, 78, 79, when we had the biggest gold and silver pump in the history of mankind. Like, timing played a role in that, I would say. But it's such a fantastic story, guys. And I would recommend looking into that story, especially if you're a new trader. There's two things that I think, if you're a new trader, that you need to understand, that you need to kind of work on. One is understanding that Richard Dennis story, but also prospect theory. I've talked about prospect theory in the past, just understanding how prospect theory kind of forces our decision making. And so I just wanted to kind of bring that up because we were talking about it in the power hour a little bit, and I just thought there were some lessons that we could take from that. Now let's come back to the time frame here. And so when basically when I'm trading my day trading system, guys, I focus on the 30-minute chart and the hourly chart. That's the chart I really look at trending analysis. Now, there's a couple rules that I just do not break. Number one, I don't trade against a trend. I just don't. I just don't. If that hourly trend is bullish, I'm not going to counter trend that. I'm going to trade in the direction of the trend, period, end of sentence. It doesn't matter. Trade in that is one of the funniest memes I've seen in a while there, Gabber. I saw it the other day as well. So funny, by the way. So funny, by the way. Yeah, Lewis, that's kind of what Gabber just put out there. My goal is to make $100,000 this year, and I only got 152,000 to go. Right? That is such a fantastic meme. But how about we turn that around, right? My system. If my system is turning 1 million into 1K, then we need to flip the script, Lewis, right? Would you agree with that, by the way? We need to flip that script a little bit. I have felt that in my own life, by the way. I have felt that in my life. But I never trade against the hourly trend, guys, because I have a tendency, I figured you were, brother. I have a tendency to overthink things. And because I'm a deep analytical person, when I go into my micro analysis against that 1 hour trend, I convince myself of a whole lot of things that may or may not be there. For example, when you're looking at the market here today, we got a nice little bullish move. Bears haven't had real hope in this bull move ever since Monday morning. It's been bull. Even on the downward pressures in price, that's bull on bull crime, guys. That's not bearish. That's not bearish. That's bull on bull crime. Every part of this price action is bullish. Every single degree of it is bullish. The downward pressures in price, that's bull profit taking. Bears aren't touching this, to be perfectly honest with you guys. And the reason, because all the money is pushing towards the top side. And so, whereas other traders might look at this situation right here at 6,200, and they might say, well, I'm going to look to counter trend that. The 1 hour trend is bullish, but because I expect a pullback, I'm going to counter trend the pullback. I never do that. I never do that. I never counter trend that pullback because the probability is towards the top side. And I always want to trade in the direction of the existing trend. And so I'm always going to identify that trend. Sometimes I feel like that trend's easier to look at on a 30-minute chart. Sometimes I feel it looks like it on the hourly chart. But that's my primary trend line, my time frame to do my trending analysis is that 30 to that 1 hour time frame. Now, when I look to drop it down time frames to look for patterns and execution, I do a lot of that on either a 5-minute chart or a 15-minute chart. When I have a consistent trend, guys, it's not a 5-minute chart. When I have a consistent trend and I feel confidence in that trend, I don't want to shortchange things. I don't want to micro analyze things. I want to be in that trend as long as that trend is intact. And so I feel like doing it on a 15-minute chart is really good. And then when I'm going in to actually put in the trade, that's when I look at it on a 5-minute chart. And so when you're in that, when you're understanding your time frames, you just go back and forth into your time frames. You go from your hourly chart to your 30 to your 15. And like, for example, today, and really kind of over the course of the last couple of days, I've kind of felt like I've been living on that 15-minute chart a little bit more than, say, the 5-minute chart, just because of, again, I felt like the consistency of the market was enough that I didn't want to like micro analyze just smaller levels that really were not important to the overall market. Now, within that trend, I navigate it through the 1, 2, 3 pattern. And the 1, 2, 3 pattern is basically how I label the pattern development that occurs within an existing trend. And so there's 3 patterns that make up the hallmark of a trend. You got your breakout, which are your momentum-based patterns. You got your overextension, which is I just tap on the brakes and don't counter trend overextension. And again, I'm not trying to judge scalpers who do counter trend that, not at all. It's just my mind does not allow me to do that because I choke it off too much, quite frankly. And so I don't ever go against the extension. What I do is I call for secondary patterns. So if you ever hear me say, oh, that's a really good secondary pattern, that's typically coming from an extension area that got alleviated through pattern development. See, overextension does not have to come back down. Simply because price goes up, 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 does not mean it has to come down, guys. That's not what it means. Price goes up, price goes down, does not work that way. Price goes up, price can consolidate, price can fade, price can do a lot of different things. So when you get into that overextension zone, you really start looking through the lens of pattern development. Are you going to get a shallow flag? Are you going to get a high base? Both of them look really good with momentum. Are you going to get more of a standardized bullish retracement? You go into pattern recognition mode when you get into overextension. That's going to make some sense when we start breaking down kind of those two trades that we're going to look at here today. And then obviously the third is that standardized bullish retracement. And these patterns, guys, they manifest themselves at almost every aspect of a life cycle of a trend. When you see that breakout, 1 gets into overextend, and 2 pull back, 3 rinse and repeat over and over and over again. Now, I want you guys to write this down. Okay, it's a saying I have. I'm not here to catch a trade. I'm here to catch a trend. There's a difference in those two. Now, what do you guys think is the difference between trying to catch a trend and trying to catch a trade? What do you think? And I want you to give it some thought. I want you to think about this one, guys, because it's a big difference. Because I kind of feel like, for the most part, a lot of people who want to day trade, learn how to day trade or day trade, they come to and they get a account, they go out there and quite frankly, they all just try to catch a trade. That's all they ever try to do, is catch a trade. So everybody give me your thoughts. RQ, I'll get into that. RQ, I got into an argument today with someone on YouTube that said we're still in a bear market, RQ. Oh my goodness, we're 20% off the lows, bro. That's the definition of a bull market. That is so funny to me. That is so funny to me. Boba, $2. Catch the trend, need to wait for good position. Okay, that's some of it. Take profit early. All right. What I mean by that, guys, is let's say you're tracking this pullback here, right? You're coming down, 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 and you get that upward movement in price, and you go out there and you make that trade. And let's say you get into it right there, and you get a stop loss right underneath the pivot, and you feel good. You're trading with the trend. You got it at a good position. You got a good reward to risk ratio, and the only intention you have is to capture this upward movement in price. That's a trade. You catch it at the right time. You got a positive reward to risk ratio. You got the probability on your side, and your intentions are solely to catch the wave. That's it. That's catching a trend. Whereas if your intention is to, that's catching a trade. If your intention is to capture and let me kind of come to all these drawings here. If your intention is to capture the trend, you're still going to put the enter here. You're still going to put a stop loss there. What you're not going to do is close the trade just because you have profit. Does that make sense, everybody? What you're going to do is you're going to stay in the trade as long as it stays bullish. And so what the trend trader tries to do is they try to stay in the trend as long as the trend stays intact. And so instead of taking that stop loss, which is down here initially, and trailing it up all the time and then just automatically getting out, well, what they do is they'll trail their stop loss underneath the pivot within the existing trend. And so the difference between somebody trying to catch a trade and somebody trying to catch a trend has nothing to do with the initial conversation of what trend are you in, or what pullback are you trading, the breakout, or you're trading a pullback. And it has every single thing to do with too aggressively trailing up a stop loss. Because what I have understood, and you just tell me if I'm right on this, guys, have you found yourself doing more scalping than day trading? What do you guys think? Scalping is the lower time frame to the day traders. And in that scalping, have you felt like you've left some money on the table because you haven't let the trend go play out? It's not your entry that's the problem, guys. It's not. It's not the entry that's the problem. It's the managing of the profit loss. Instead of managing the trade and the trend, you're managing the P&L column. And I know that without you saying it, because you're choking off trades. Would you all agree with that? And at the end of the day, much like all those other traders, guys, in the turtle traders, 11 of the 12 guys, 11 of the 12 turtle traders, what did they do? 11 of the 12. They got out of the trade. They never pulled the trigger, or they got out of the trade before it came to fruition. Okay. 11 of the 12. The only one that stayed in the trade was the 18-year-old kid who had no relationship to money, had no fear of that unknown. He's 18, right? We all wish we were 18 without kids and life and family, and have all the fears known to man, right? Have kids, you'll have fear really, really, really fast. But they stayed into the trade. It's our job, guys. Sometimes the market's in a mode where, yeah, I just want to capture a trade. Absolutely. There's other times I want to open it up and let it run, though. There's other times I don't want to choke off price movement. There's other times I want to allow the market to breathe a little bit. Does that make sense, everybody? Like this week. This week I thought was a real good example of what I'm talking about. How many trades have you guys, like day trades? How many day trades have you guys made this week? How many day trades? Scalps, day trades, you tell me. We're 4 days into the week. How many have you made? Just ballpark it. About 5 per day. If you're scalping, it's quite a bit. 20-ish. Okay. Now, I'm willing to bet that you guys have made more quote unquote day trades this week than I have. I'm willing to bet that. Okay. Because I have 5 this week. 5. But I've also captured 80% of the price movement to the top side. Second question I have for you guys. What percentage of this overall movement to the top side have you captured? About 60. That's not bad. That's not bad, MJ. Okay. If you're trading in the right direction and you're only capturing maybe 10 to 1% of the move, what's going on? What's going on? RQ7, -7. Do you think maybe, hypothetically, 2 mistakes? Is it okay if we talk about mistakes, guys? Is that okay as a coach with a lot of experience dealing with other people, coaching as many people as I have? Is it okay if I help correct mistakes? Is that okay? Okay. Now, awesome. Thank you for that. Okay. A couple problems probably here. Number one, it is impossible. It is impossible to capture more than 60% of a trend if you're looking at a 1 minute time frame. That's impossible. It's impossible. So if you're looking at a 1 minute time frame, are you going to get stopped out of trades quite a bit if you're doing anything on a 1 minute time frame? What do you guys think? Yes. The answer is yes. The answer is yes. You will think things are reversing when they're not. You will think momentum is changing when it's not. You will get misreads off that. And if you are not a perfect, and I mean a perfection as a technician, like you have a complete understanding of all forms of technical analysis, you should not be trading a 1 minute chart. You're just going to get stopped out. That's all that's going to happen. You're going to make a little bit of money. You're going to get stopped out a lot, and which means you're going to have a high batting average. Your return versus risk ratio isn't going to be that great, but you will have a high batting average. Okay. So if you're doing a lot of things on a 1 minute chart, this chart, for example, just today, it's been choppy. You would have got kicked out of a trade here. You would have got kicked out of a trade there. You would have got kicked out of a trade here. You would have got kicked out of a trade there. You would have got kicked out of multiple different trades here. You would have stopped out just on this trend at least 10 different times, at least 10 different times. Whereas if you look at it on a 15-minute chart, that same movement here, guys, that same movement here, I didn't get stopped out till right here. Okay. Now, this first trade I made today, let's break it down. Why did I like it? What did I do with the stop loss? When did I get out? This first trade I made today, my target was 6,200. I did not have a different target. 6,200 was my target. It's been my target all week long. In the power hour, I think I've said 3 different times this week, there is a magnet at 6,200 and the bulls are not going to stop until 6,200. I've said that 3 different times this week in power hour, ladies and gentlemen, 3 different times. So when it hits 6,200, I'm not too shocked that we're seeing consolidation here, everybody. It was supposed to do that. Now, when it comes to the 1, 2, 3 kind of pattern here, you deal with 1 is breakouts, 2 is extension, and 3 is the retracement. Now, what I liked about the market today coming into the cash open was it was a very clean cash open environment. And that's going to be very important for me. I don't take dirty trades, guys. I got to have a clean level. If I don't have a clean level, I don't have confidence in the price projection. I won't make the trade. And so I really liked this morning that we had. Oh, what in the world? I think we just got booted here. For some reason, it booted us. Just shut down. Can you guys see again? Yeah, it was a Discord drop. Did everybody get kicked out? Yeah, I got kicked out too. Okay, so let's come back to this. What I liked about today's setup, and I think you can rinse and repeat this any day we see something like this, guys, is I really liked the consolidation right here at 6170. Like I am a trend, a pattern, support, resistance guy. I like secondary indicators to confirm the decisions I'm making based on price, but I'm a price trader. I'm a pattern trader. I'm a trend trader. And so when I'm looking at this level right here, and it's really clean all night long, right? I didn't see it all night. I went to bed like right here, But when I woke up this morning, I usually wake up about 6 o'clock my time, about 30 minutes before the cash open. And so I don't do a lot of pre-trading, like pre-futures trading. Like the first I'll do is kind of after the cash open. And so you saw the cash open kind of right into here, and it really didn't do anything too aggressive, just kind of inside candle, nothing too outside limits there. And then you get this candle right here about 40 minutes into the trading session. You see how it goes above the resistance channel. Now, I want to talk about entry technique here because I think it's important. Jesse Livermore, who I have talked about in the past, greatest trader of all time, he said confirmation is the insurance that you're right on your projection. How often, when you guys are making a trade, do you mentally think about confirmation? What do you guys think? Like when you made a trade today, did you mentally think about confirmation? Yes or no? RQ, yes. Bucky, yes. Good. KLT, no. Aaron, that's because you're not going through the mental process of confirmation. Whenever you're doing an entry, guys, like you hear from RQ, Bucky, you heard it from Lewis. Like whenever you're thinking entry, you got to think confirmation here, guys. You have to think confirmation. Confirmation is the insurance that you're right on your projection. If you're not right, you shouldn't make the trade. It's everything that you're entering the position in. And so the concept of confirmation, and LeMay's, that's a good, you wait too long and you might miss it, right? Okay. Well, that's obviously things we got to work on, because confirmation isn't waiting for candles. What is confirmation? Everybody give me their one sentence definition of confirmation. I'll do it too. My one sentence definition of confirmation, and you tell me if you agree with this. Does the candle close above resistance? That's my confirmation. I've identified resistance. Does the candle close above resistance? That's it. It's not more than that, guys. It's not more complicated than that. You have to identify that resistance level, right? You have to identify that resistance level. And so I identified the resistance level that I was anchoring at 6170. And I said, okay, now we got this candle right here. Let's kind of zone into that candle right here. So we got this candle, it tests above the breakout zone. Okay. Now there's two types of traders when it comes to entries. You got the aggressive trader and you got the conservative trader. Now, I want you guys to tell me who you are. Aggressive traders would see this candle test above the wick and they would say, all right, enter right there. That's the high of the wick. I want to get an order above the high of that wick so that I get in as it breaks out. That's aggressive. You put your order above the breakout channel, above the wick on the breakout channel, to say, I want to get involved with the movement. Because because we all know this. How many times have we seen breakouts and then just go up, 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 up? And so the aggressive trader says, I'm willing to take less probability because it hasn't technically confirmed yet. You're putting your order in an area that you're anticipating confirmation. And so the aggressive trader puts their order in above the breakout channel, anticipating confirmation on that. Whereas the conservative trader will allow the candle to close above resistance and then trigger in above the candle high on the confirmation itself. Either way is fine. But which one are you guys? And really, I think that's just what it's really about, knowing who you are. Sometimes I'm an aggressive guy. Sometimes I'm not. I'll tell you when I'm an aggressive guy. is when I have a confidence in trend. If I have confidence in trend, I'm much more aggressive. If the pattern's going into a breakout that would define a trend, I will be more conservative. And I'll explain that here in a second. You'll buy in the close of the first candle? Yeah, see, that's just where it sets the analysis for me there, Boba. That's where it's like, okay, all right, all the front runners here gone bad. Yeah. This would be the entry candle. This would be it's just testing above it. This is an entry candle. Okay, and waiting for a retest is fine. JP, the problem with that is in a strong trend, you're not going to get a retest. You got to make a decision. And so if you're tracking a clean breakout, I would just say take the clean breakout. Like that's, to me, I wouldn't wait on a retest. And again, there's nothing wrong with waiting on a retest. I'm just saying, like, if you have a clean breakout, like, don't wait on the retest, front run that, take a partial position, JP, and then you can add on a small position on the retest. Does that make sense? Like, don't sleep on breakouts, guys. Breakouts are the #1 momentum trade in the market. The snapback retest or the snapback flag, that's a loss of momentum pattern. It's not an increasing momentum pattern. And so if you're going to wait on the retest, nothing wrong with that, but just scale into that if that makes sense. Okay. So on this trade here, I saw it test here, and then I waited on the close, and then I got in here right here at 61.76. Now, stop loss. So that's how you handle entry. You got aggressive, you got conservative. The difference for me is if it's an existing trend or not. Because the market had consolidated here for a good 10 hours, maybe not 10, like 7 hours, I wanted to see the close. I wanted to see the close. I had a couple wicks above that 61.70 level, couple wicks, like you had a wick right here, wick right here, wick right here. Obviously, the candle wick right there. I had a couple wicks above that level. I wasn't very comfortable with that. I wanted to see the close. I triggered it in above the close. Okay. Does that make sense on the entry, everybody? Okay. Now, the ultimate question now is once you're in, when do you get out? When do you get out? Now, where did anybody else make this trade on the breakout following the cash open today? It was a pretty clean setup. I'm sure some of you guys saw that. Some of you caught it, I'm sure. Yeah, it was clean setup, real clean setup here. All right. How long were you guys in that trade? And again, I am not judging because you guys have a different time frame than I do. I was in that trade until this candle right here. This is when I got out of the trade. So I entered into the trade here. The very second it got above the high, I stayed into the trade the whole way until here when it hit right here when it hit 61.98. I should have got out because my target was 6,200, but I got out once it got underneath the 90 EMA. I actually thought it was going to close here. And so basically what I said to myself is I said, okay, I'm going to stay in this trade as long as it stays above the 90 EMA here. As long as it stays above the 90 EMA here, I want to stay in the trade. Very similar to when you were looking over here. As long as it stays above that 90 EMA, I want to stay in the trade. As long as it stays above that 90 EMA. So you see that consistency? That was just yesterday, guys. And so you come here today on that breakout, I basically said the exact same thing that we saw play out yesterday. I want to stay in that trade as long as it stays above the 90 EMA on that 15-minute time frame. And so once it got underneath here, I manually closed it because I thought we were going to see a little bit of a deeper pullback there. And so again, just thinking about this from an entry technique perspective, guys, once again, it's not necessarily judging one or the other. Like I do them both. Sometimes I'm aggressive, sometimes I'm conservative on entry. But does it make sense to you guys now to kind of look at it from that lens? always think about it, guys, just in your back of your mind. Go through the process of, do I need confirmation? What's the analysis going into it? Do I have a trend? Do I have momentum? Like, if you have a trend and you have momentum, you don't need to see the close above resistance. If you have trend and you have momentum, you can just simply be aggressive in that. But like I was seeing last night, seeing that consolidation here, I kind of felt like I needed to see confirmation. I need to see confirmation. And so sometimes I need to see it, sometimes I don't. Some of it really kind of depends on the momentum of the condition. I also want to bring up your indicators on this a little bit as well, because I thought the indicators were really, really compelling on the 15-minute chart here to give secondary confirmation. When you were looking at oh my goodness, did we do it again? Discord. Are you guys back? Everybody back? Discord giving us heartburn today. As long as we're back, though. As long as we're back.
Discord's being weird.
Is it just in general, Steve? Like, because I've seen this a couple
they're
times
having
today.
something. There's like a RTC error or something.
Okay.
It cut off every single stage in this and in here, and then also in the other server that I'm in.
So it's basically a Discord server issue, not just our server issue.
Yeah.
Oh, the man's trying to hold us down, gents. The man is trying to hold us down. We're not going to let him, though. We're not going to let him. All right. So what I was saying, though, on the entry here, just go through the thought process on the aggressive v. the conservative entry technique. Okay. Probably argue. Probably. All right. Now, I want to take a look at another trade that we were looking at earlier this week. And this trade we were looking at on Monday. And you guys might recall that trade on Monday. And if you recall, and I'll kind of walk you through the analysis here. All right. So you remember going back to Monday. We dealt with that gap down candle on Monday. This is Monday's candle. Okay. So we're in the back test. We're on June 23rd. So this is Monday's pricing here. And so basically you had that gap down candle here on Sunday's futures open. And then Monday it fought all the way back up into this overhead resistance level. And that's where we kind of start this saga. And so let's go into the 15-minute chart here so we can see it. All right. So here's the gap down. This was so fast, guys. I don't know if you guys were watching the market on the futures, but I was watching it like a hawk because I was ready to trade crude oil. And crude oil gapped up, ES gapped down, and it was fast, guys. Like it did not, let's just say it like this. It didn't take 15 minutes for this candle to get back up here. It was pretty fast. And so the gap down kind of got smoothed out pretty quickly. And then we saw some gap fills. Riz and I were actually on Sunday night. We were kind of breaking it down on Sunday night in Discord. But the trade I want to talk about is not anything on the recovery here. The trade I want to talk about is actually this trade, the breakout of 60.70. Now, the market right here had kind of opened up a little bit sour, coming down into intraday support levels. You had some data came out that shifted the probability pretty quickly, and this thing screamed up, guys. Very fast moving market all the way back up into the overhead resistance. Now, there's a couple things I really, really, really like in terms of intraday analysis, but it happens on all time frames, quite frankly, is when you get into a resistance level that has a lot of historical action to it. So at 60.70, for example, well, last time we drilled this number, we came all the way down. And it's not just that one time. You can go back in time a little bit. So if we connect those dots and we draw that trend line a little bit more, there we go. We draw that trend line, you got this resistance, 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 just a battle zone of a resistance level. And so looking at that resistance level, it's a very aggressive resistance level. And so in looking at that resistance, we saw a market that was recovering very quickly. Now, when the market came into this overhead right here of resistance, you don't chase this movement, guys. Like you're never going to chase 3 big candles going into a massive resistance level. You're going to be overextended in that scenario, and you're going to say, okay, give me a secondary pattern. Remember the 1, 2, 3. 1, you get the breakout. 2, you get overextended. Well, here you got overextended pretty quickly. 3 big bars got overextended. You're coming into a major zone of resistance. You're going to want to see development. Patterns are important when you're going into resistance in an overextension situation. You're going to want to see that get alleviated. The overextension gets alleviated through 2 ways. 1, you either come down in price, forming a retracement, or 2, you can consolidate. Because when you think about RSI, when you think about MACD, when you think about stochastics, when you think about these traditional indicators, they use historical data, which means the further it consolidates, the more the data is suggesting no momentum. And so as you can see here, 15 minutes, 15 minutes, 15 minutes, 15 minutes, 15 minutes. You had a good 2 hours of consolidation here where the market just basically flatlined. That is not bad. That's really good. You want to see that play what I say it's playing defense up against above the price, but you want to see that really kind of develop right here. And the reason you want to see it develop without too much to the downside is what you're really trading is the breakout here. And so ultimately, the first question that I have for you guys is, did I need to see confirmation on this trade, on the entry? Pretty substantial resistance level. What do you guys think? Did I need to see it, or did I just go? What do you guys think? If you were in the stream on Monday, you should know. Now, I will say this. Personally, based on the totality of the data here, I would need to see confirmation. Personally, I would need to see it. The problem with this one, it was 10 minutes before the close, and we were doing a front run on the 10-minute pump. And so I didn't wait for confirmation. I had the order right above resistance. And then what happened is on that pump, we got pulled into the trade. And the target, if you guys will recall, was 680 by 6,100. That was kind of the 2 target we were talking about in that moment. And so when you're looking at this situation was a little bit unique. And the reason I just want to explain this, because in general, I would say I need to see confirmation here, because you got a multiple time frame resistance level. I have a really strong opinion of that resistance level. I know it's going to be a good breakout if it can stick the landing. But again, there was just way too little time going into that 2 p.m. close. And so I just wanted to get into the trade, quite frankly. So I was aggressive because of the timing. Now, Gabbert, in a cup and a handle continuation pattern, and that's kind of what we saw here on the daily chart. Have a little bit of a cup, a little bit of a handle there. When you're dealing with a high base on the 15-minute chart, when you're dealing with the cup and handle on the 5-minute chart, both of them would suggest the breakout. The stop loss would be underneath the pivot point. And so your stop loss is going to be underneath the pivot point right there initially. But you're not going to keep it there. You're going to smack that pretty quickly into right underneath the breakout channel fairly quickly into the trade. And so initially I'm going to want to get the base here, guys, on the stop loss, because I don't want to get stopped out in this tight range here. There's so much price action there, like so much price action there. Like that's where the price is living there. And so I don't want to get stopped out where there's a lot of price action. I want to get it underneath the base. So to me, it would have been underneath this level at 58. And so 55 feels really, really good. And so, yeah, Gabber, RQ, we're all saying the same thing. 55 gets the wick here. Now, let me come back out real quick here just to scale this. So where I had mine initially, and I'm going to go fast forward here, but where I had mine initially was right here. I didn't get the base here, Gabber. I just got the base of the wick. You see that double wick low right there? That's where I got it. That's where my stop was underneath 58 was where mine was, but I would have no problem at 55. All I'm saying, and I think RQ, we're saying the same thing, underneath the pattern. Okay. When you're a pattern trader going into the breakout, you're basically enter above the pattern and your stops under the pattern. Does that make sense, guys? And then when the market breaks out and gives us that move to the top side, we're pretty aggressive to trail that stop loss up. And so if the stop loss is here initially, and we enter upon the breakout right there, well, I'm going to take this stop loss and I'm going to get it underneath the breakout channel fairly quickly. And then once that happens, my next trail will be underneath the 9 EMA on the 15-minute chart. And so I'll take the stop right here initially and smack it right underneath the breakout channel. And then once I feel comfortable on top of the breakout channel, I start trailing the stop loss with the moving average, the 9 EMA. And on an aggressive trade, I'll trail with a 5-minute 9 EMA. On a more consistent one, I'll trail with the 15-minute 9 EMA. Does that make sense, RQ? Okay, good. Oh, and by the way, is this helping, guys? Are you guys enjoying the lab today? Yeah, Aaron, I think initially people do trail stop losses too much in general. I anchor against the 9 EMA on a lot of different time frames. Like on a swing trade, that's kind of my zone that I trail on the 9 EMA. I don't trail every candle though. Like I just don't. I've told you guys this a lot. I'm not as fast as you guys are when it comes to the trading decisions. I like to see things play out. I like to let trends play out. I like to let patterns play out. I like to let my analysis play out. I put a lot of emphasis on my ability to read the market. I don't want to get ticked out of a trade just simply because it gets a little tiny bit dose of volatility. That's because everybody just wants to get a trade, RQ. And I'm telling you right now, everybody just wants a trade. They just want to trade. They just want to trade until they learn how to catch a trend. And when they catch a trend, they're like, oh, well, whoa. I don't have to aggressively manage every single aspect of everything like a scalp. No, you don't. And so I think there's a fundamental difference in the trading styles of catching a trade versus catching a trend. The catching a trade philosophy is swing trade scalping philosophy 101. Like if I'm looking at a daily chart, for example, I'll just try to ride the wave. Whereas if you're doing a position trade, you'll trail stop under supports. So it's just a little bit different. But you see how this one triggered here? Okay, so it triggered here. I'm not going to trail stop loss yet, though, guys. Not yet. We just got into that initial trade. And so initially, I'm not going to trail. I'm just going to let it play out. We're in the trade. I don't want to trail. I'm going to trail when I know I have momentum on top and I can deal with a little bit of pullback. Until that 9 EMA is above that breakout channel, I'm not trailing, guys. It's when the 9 EMA gets above the breakout channel, then I trail it right underneath the breakout, and then I'll trail with the 9 EMA on the 15-minute chart on the top side. Ernie, you're in the right place because I love teaching people how to read charts, Ernie. Ernie, what I would suggest if you're real new to this lab, we started this lab a couple, 2-3 months ago. We put up all the labs on the BluSky YouTube channel. Go look at some of those early labs where I was just doing some definitional teaching. I did, like, for example, I'll just kind of give you a lay of the land here, guys. I got a PowerPoint on it. So, for example, Bucky, do you see this right here? So, like, our first lab is on trend analysis, okay? Our second lab was on secondary patterns within a trend analysis. Our third lab is on the news-based trade. Our fourth lab is on day tradable instruments. Our next lab is on understanding MACD, RSI. We did a lab on understanding stochastics. We did one on Bollinger Bands. We did one last week on basic options. We've done others on backtesting. We're doing one on kind of backtesting entries here. And so, yeah, we've done quite a bit of them. And they're all on that the BluSky YouTube channel. So definitely check those out and then come join us every single week in this lab as we kind of work on our technique every single week in this. By the way, this trade on this one here, if we just go back, if we go, and I'll just kind of show you the end conclusion here on that one as it's playing out. But if you go back in time, that trade is right here. It's this trade right here. There's the breakout candle. There's the reopen of the futures. And eventually, this is where I got stopped out later that night. So my first entry was here. My second entry add-on was on the reopen. And then I initially got stopped out here. And I did make this trade, but it was a go-to-bed trade. It was a different trade. So, guys, that's what I had for the lab. I wanted to go through a couple trades that we saw in the stream this week. Just kind of wanted to explain it from an entry and a stop loss perspective. Did you guys have fun today? I did as well. I did as well. All right. Let's throw it out. What do you guys want to work on next week? What can I prepare a lesson on for next week? Let's throw out some ideas, guys. What do you guys want to do next week? We'll do cover call. We won't do cover call next week. We won't do cover call next week. Risk management. That goes to like position size rules and stop loss rules. That's a good one. That's a good one. Let's do a general position sizing, stop loss, risk management one. Obviously, we'll do it through the lens of making a trade and you know what we're doing here. But I like that topic. Boba, is there any method to warn us when we are looking at the wrong time frame? If you can't get a good consistent read, you're looking at the wrong time frame. I thought the 15-minute chart was the chart this week that was very consistent. And what? Okay, I'll just give you like a real quick case study on how I do it, Boba. So, do you see the consistency? And again, I'm just going to bring up my 9 EMA because it is an anchor for me quite a bit. So I'm just going to look at the 9 EMA here. All right. Do you see the 9 EMA here on this trend here? See how it acts as a support level right there really consistently? See how it's acting as a support level really consistently on the lows here? That's the 9 EMA, guys. This 9 EMA. JP, I've done the indicators, MACD, RSI, Bollinger Bands, stochastics. Check out YouTube, the lessons there on the BluSky YouTube lab. But do you see how we're very consistent here? That to me is because that's an algorithm. Whereas when I come out to like, say, the 30-minute chart this week, like I don't see as much consistency here on the 30-minute chart. And so I kind of look at it from a time frame perspective. I'm always looking at the 30 or the 60-minute chart to identify trends. Like we got a bullish trend. I'm not looking for bearish. I'm looking for bullish patterns. I'm looking for bullish breakouts. I'm looking for bullish retracements. I'm looking for bull, right? Two, coming from a perma bull and losing trader, how and when do you decide this trend no longer holds? That's a fantastic question. Well, let me put it like this. I'm already out of this, my trade right now too. I got out of this trade right here earlier today, right here. This was the candle I got out of the trade. And the reason I got out of the trade was because the trend I've already felt was ending. And so I kind of have an opinion at 6,200. And so I already believe that 15-minute trend is over. And so what I would suggest is what we're now starting to see is the early beginnings of either a continuation or a reversal pattern. I have a massive opinion at 6,200. Like my opinion at 6,200, I have a ton of respect for 6,200. And so to me, I already think the trend is over. That's number one. Number two, I don't know the direction of the next trend because I'm looking at this pattern and I'm saying, okay, is this going to be a continuation breakout, which as of right this very second it is, or two, or is it going to start holding resistance and work into reversal formations? And so for me, at this point, it's the difference between the continuation versus the reversal saga. And that to me is all about whether or not we can get a clean breakout. I am not looking to counter trend this yet. Not yet. Not yet. It's going to have to give up a little bit more for me to be like, nope, that's no longer bullish. Like I'm going to have to see a pullback followed by a double top. Like I'm going to have to see a reversal here, period, end sentence. It is. That is my anchor at a resistance level right now. It is. And it's not, and I'm not surprised to see this consolidation either too. And so, for example, me and Gabber were talking about this on Monday this week. And both of us were like, yeah, there's a magnet at 6,200. There feels like the bulls want to achieve 6,200. The bulls and the 6,200 zone is significant because that's kind of right into the all-time high zone. Kind of that's right into that support resistance zone. That's also right the price we gave up when we started the tariff saga from a few months ago. And that's also Steve's target. That's right, RQ. That is also Steve's target. But yeah, I was anchoring against 6,200 because I have an opinion at 6,200. And so I was going to get out before 6,200. And that's just because I think there's going to be some development here. But in general, I see it through the lens of continuation versus reversal analysis, which I also feel is a very compelling lesson that we should go through. So in fact, I just changed my opinion. We're going to do continuation versus reversal patterns next week because too, I just think this is a wonderful conversation that we should take it to another step. And so we're doing continuation versus reversal patterns next week. We'll do more position size, stop loss management, and overall risk analysis the week after. I think so, RQ. I think so. Yeah, because like for example, a reversal on a 5-minute chart might just be a continuation on a 15-minute chart. You got to be able to look at the two. You're absolutely right. 100%. 100%. And that's the thing about day trading, guys. You can't get so stubborn on one time frame. You got to have a perspective in the context of the other time frames. That's true. That's true. Well, guys, I thoroughly enjoyed this conversation here today. Thank you so much for coming out and supporting the BluSky Trading Lab every Thursday, right after the market close. We'll do it again next week as we have the conversation of reversal versus continuation. And with that said, guys, I hope you guys have a wonderful, wonderful rest of your night. And we'll see you tomorrow. Later, team.